Welcome, this is Keith with Renovation Funders, and in this video I'm going to walk you through the calculator that you're looking at here. It's our spreadsheet that indicates whether or not we believe it's profitable for you to partner with us, and of course whether or not it makes sense for our investor to partner with you as well. And I want to make this available to you and kind of walk you through it just so you know the calculator does appear. There's a link below this video, and if you click on that link, and if you have Microsoft Excel, you can download this calculator and use it for yourself to plug in your own assumptions. Okay, so let me walk you through this calculator. The numbers I have pre-populated here, let me show you. This actually is a deal that got submitted to us last night from San Francisco, and so a seller has requested to partner with us, and these are the actual numbers. They have a very expensive home. Right now it's worth, as is, $1.6 million. Okay, that's what they think. And I assume they have liens of $1.3 million on it, which is only 80% of the actual value. I shouldn't say only, that's a lot of money. I don't know for sure because I haven't spoken with them this morning yet, but I think, that's a good safe bet. It's going to be this or less. So that's where that came from. But the rest of the numbers they gave me. So they believe that the project will sell for $2.7 million. That's what this line is here. ARV projected up front, which is after renovation value. After renovations, they think it's going to be worth $2.7 million. I have a field here so that they can plug in the actual sale price that occurs so that they can see down here what their estimated profit or gain would be by working with us on this particular project. Okay, so they can say, well, what if it only sells for $2.5 million? Geez, what if it sells for $3 million? And then they'll be able to see how that impacts their bottom line. Okay, so $2.7 million is what they think they'll get. $1.6 million is what they think it's worth. $1.3 million, my guess on what they owe. For now, I'll get confirmation of that later. If I'm accurate on this, they're going to have about $326,000 in equity at the moment. Okay, as is. Now, the renovations that they've asked us to pay are $300,000. Okay. This is a pretty substantial project. Normally, renovations don't get anywhere near this high. And in this case, they think the renovations may be $400,000. Well, they realize we have a cap of $300,000 to spend on any one project. And so they believe in the project so much that they're willing to put in $100,000 more of their own cash to get this project done. So this is the amount that they've asked us to pay. Renovations by investor. Renovations by owner. Usually it's zero. Usually we pay for the whole thing, but in this case, $100,000. Of course, you'll put in your own numbers. Now they think it'll take about 5 months, start to finish, to renovate this property and get it sold. This number here is our investors' profit. It's how they make money, and what they do, it's kind of like a realtor. We set a percentage of the sale price. The ultimate sale price is the amount of proceeds, the profit basically, that goes to the investor who will be on board with you. So in this case, they need 4.1%. This is negotiable, but they need 4.1%. And with all these numbers, if they come out just like they've been inputted here, the owner probably is going to make about $390,000. Okay, so we put in those assumptions. For this property, I know property taxes run about 1.25%, 1.3% in the San Francisco Bay Area here. Of course, you'll know what the percentage is in your neck of the woods. You can put your own in. If they have loans with interest that they have to pay, and again, I'm just assuming for now, $1.3 million, and I'm assuming an interest rate of 5%. You put in the interest rate that impacts you for your own loans. Okay, and I throw in some miscellaneous during renovations. We're going to have utilities and some other miscellaneous costs that'll come up. Put in your own number. $200-300 for small projects should be good. Bigger projects, use your own discretion. So we'll have an estimate of what it costs us just to carry that property. The property's carrying costs at $7,500 per month for the duration of those 5 months. Okay, those are carrying costs. Once you've plugged in these numbers, your best guesses, okay, and what you think the sales costs will be for the closing costs when you sell, and how much you're going to pay the realtor when you sell. Once you've got all these yellow fields plugged in, all the rest calculates automatically for you. So let's say that this property gets renovated, goes on to sell, just like the numbers here represent. This is what happens. The sale price is $2.7 million. The renovation cost reimbursed to the investor is $300,000. There's a JV facilitation cost that goes to our company of $15,000 up front. Investor pays this. There's a JV closing cost. Okay, so we'll close on our JV agreement essentially. That's a fairly nominal closing cost for that. The investor's sale price participation, again, 4.1% of the sale price. That would equate to $110,000 in this scenario, this case. You got your closing costs when you sell to the end buyer eventually, and you've got the realtor to pay when you sell to the end buyer eventually, and then the owner's got to pay off their underlying liens, and then what we're left with is their sale proceeds. This is their walkaway check. It's not profit, it's their walkaway check. To figure out now what their profit is, how you'll figure out what your profit is, come on over here to the estimated gain section for the owner. So we know that the owner's proceeds, the sale proceeds, are $853,975. We know that the carrying costs are about, or we expect them to be about 5 months times that monthly total cost. That would equate to about $37,000. Now there were renovations, this is rare, but there are renovations paid by the owner in this case, so we got to take that out of their gain. They put that in. Let's pull it back out so that that doesn't add, fictitiously essentially to their profit. And we know that they had as-is equity going in, which was the value of the property minus what they owed, of $326,000. So the proceeds minus their carrying costs, minus any renovations they may have put in, plus the equity they know they had to begin with, if you subtract all these numbers, this is what we estimate the owner's gain will be by working with us. That number, of course, translates right to here, the owner's gain. So really, when you're using the calculator, all that you have to do is fill in the yellow fields, okay, and that gain will automatically get calculated. And then you can run through all the numbers and make sure you think they make sense, okay? Now, so you can see that this particular deal could be very profitable for the owner. They don't have the money to do this on their own, and so that's why they're coming to us and saying, hey, look, we don't mind paying you 4% of the final sale price because we're going to make an extra $400,000 by doing it. So that makes a lot of sense, right? But now let's see what happens if the sale price is $2.5 million instead of $2.7 million. Okay. Okay. Watch what happens to their estimated gain. It should go down, correct? And it does. Okay. So this is what I'm saying. You can change this number to whatever number you want, whatever you think is likely to happen or could happen, and you'll see how it impacts your potential gain. Okay. So let's go. So you can see there's still $200,000 in extra profit. So what that tells us is this sale price, need an extra zero here, could probably go down to about $2.3 million, and they still break even. Okay. Now, if they're convinced it's going to be a $2.7 million property, there's very little risk for them in their minds going in doing this. They think they're going to make a lot of money. So if it does sell for $2.7 million. Then, and I can't quite get that extra zero in there, they make quite a bit of money. Now I was looking at the comps and I saw a few in there that were really high. And so what happens if in the next 6 months the market continues to go up, or what if they underestimate it, because you can do that as well, and this turns out to be a $3 million deal. Well, then you can see they're making an awful lot of money, even though they're paying the investor a lot of money. Okay, because they're making a lot more, and this is what really counts. It makes sense for them to work with us. Okay. So lastly, before I let you go, let's plug in more normal numbers for around here. And actually, I'll do a low-end property for around here. This is a Petaluma property that just sold actually. So actually, this is low. It sold for $520. Now the ARV that we projected up front was $525. The as-is value of that property was the purchase price, which was $265,000. No better way to get an as-is value than use the purchase price. Okay, the liens on the property, $200,000 in hard money loan. A rehabber brought this one to us. Again, I can't get all the zeros in. $200,000. So, as-is equity, which was really their down payment, was $65,000 when they brought the deal to us. The renovations paid by the investor in this case, $80,000. Okay. And the renovations paid by the owner, zero. It was normally it is zero. Okay, usually our our sellers or our owners want us to pay for everything. This one actually turned out to be about 5 months, so I'm going to leave that. The sale price participation was less than this. Let's see. Gosh, I can't remember. Let's just leave it for the moment because I can't remember what the exact number. That one's tricky. Interest rates or property tax rates same. It's California. Now they were paying 10%, okay, on their hard money loan, and miscellaneous costs probably about accurate there. So now the number should be accurate for a deal that just closed out. The sale price was $520, okay. The renovation we know is $80. JV facilitation and closing costs, you've already seen those. Investor sale price participation in this case would be $33,000. Closing costs, realtor, pay off the loans. Owner walks away with $168,000 if we round that up. So what was the actual profit for this particular client? Well, $168,000 in proceeds minus their carrying costs over the 5 months. They didn't put anything into the renovations. We cover all that, as is equity. You know, they had $65,000 of their own money into it, and roughly their projected gain or actual gain on that particular deal was $91,678. So they went into this project using hard money, okay, and putting just $65,000 down. Ordinarily, they then got to come out of pocket with another $80,000 to pay for the rehab, but we covered that, and they end up making $91,000. Their cost to do that with us was $33,000, but we enabled them to do this project, and so they ended up putting an extra $91,000 in their pocket. So for rehabbers, this is a fantastic partnership. It can be, okay? Keep that in mind. For sellers who know that you can make a lot more money by fixing up your property, maybe adding square footage to it, maybe just dolling it up, if you know that you can make a lot more by doing that, use this calculator, plug in your actual numbers and assumptions, and you will see, and you can check it on your own and verify those numbers, you'll see what, you know, is probably a pretty realistic projection on the extra amount of money you can make by working with us, okay? So with that, I'm going to let you go. What I would recommend in this case now is to go ahead and download the calculator so you can plug in your own assumptions, and review the frequently asked questions. They also appear below this video. And if you're interested in working with us, just get back in contact with the person who referred you here. That's how we work. And then they'll put you in contact with us directly, and then we'll talk and we'll see if we can get a deal going with you. Okay? So thanks for your time. Appreciate watching, and hopefully we'll be able to work together in the near future. Bye-bye.